The market continues to bounce as expected, headed towards that Liberation Day gap that we talked about. As a matter of fact, the S&P 500 is already in the Liberation Day gap. If you're confused and you're not familiar with this channel, this is basically Liberation Day when the tariffs were announced. Now, NASDAQ is above this gap, and like I said, one of them I expect to hit the Liberation Day high, while the other one potentially stalls, and that this is looking like the S&P 500, whereas the NASDAQ is headed towards that Liberation Day high. I don't remember this many mixed opinions on the market where there are so many money managers that are still on the sidelines that haven't even pulled the trigger here, while some are claiming that a recession was already front loaded and the 20% down on the S&P 500 was the market anticipating a mild recession and pricing, so the worst is over. I don't remember a time when there were so many conflicting signals, maybe during the pandemic. So as we approach that level in the S&P 500, what I told the Traveling Trader Investing and Trading Group is I will need to see a certain criteria before opening up a short hedge, and I will share with you what that is here. And so far, as of the time of this recording, we've had two jobs data. JOLTS job openings came in less than expected, and then we also had today the ADP non-farm employment change came in way less than expected. These two are showing less job openings basically in different sectors. We do have the unemployment rate and non-farm employment change on Friday of this week. Core PCE came in at 0% month over month versus 0.1%. I went live this morning covering core PCE, trading futures live as well. Had two nice wins on stream, but finally getting weakening jobs data and seeing core PCE low. Does the Fed have enough ammo here to cut on May 7th? We'll get into that. GDP also came out negative. Remember, I told you guys the Atlanta Fed has never projected a negative GDP that came out positive. So the GDP, as a matter of fact, came out negative, but it was negative 0.3, not quite as bad as the Atlanta Fed had projected. But what is underneath the hood? We are seeing differing opinions on this. Is it really negative 0.3 GDP, or was this a product of a lot of companies front loading inventory in anticipation of tariffs, so ordering way more than they needed back in March in anticipation that the tariffs would hit in April, and that increase in inventory actually leading to a negative GDP because inventory is one of the largest factors that go into GDP. If you remove that, then we actually get a much more, I guess, sanguine outlook on GDP. However, I looked at this chart here that was shared by Nick Temeros of the Wall Street Journal. We had a negative GDP, but real final sales to private domestic purchasers were at 3% with a negative GDP. Do you know when the last time this happened? Was Q1 of 2022. This is not the only thing that happened in 2022 that we are seeing similarities now. I will tell you what else I'm looking at. But I just want to say, remember that chart that I shared with you guys that showed that the stock market will bottom before a recession is declared. So say this is a negative GDP and say the next quarter is a negative GDP, the stock market will likely bottom before that second negative GDP reading comes in, if it is negative. The question is, will we see more downside in the coming days before obviously that Q2 GDP that will come out in 3 months? Now, the S&P 500 is up 7 days in a row, but if we take a look at the S&P 500, not only are we below the 200-day moving average, we're below the 300-day moving average. Up to a month out, results are really murky. With even a month later, it's about a 50-50 proposition whether we are green or red from this level. However, look at the percent positive for basically the next week. It's in the 20s to 30%. So most likely we will see a retracement. Now, this is important because, as I told you guys that missed out on buying the dip, even though I was screaming and hollering about some stocks being too cheap to pass up, but that's neither here nor there. I was saying if you miss the ultimate dip here so far, I don't agree with chasing stocks on the upside. I think that you need to wait for red days to invest. I don't think that you should be pulling the trigger at the highs because you're going to sustain way more losses than necessary in the short term and not get the best price possible, because for sure after a rally like this, we're going to see a retracement down. You want to invest on those retracements down. Now, today, as of the time of this recording, Wednesday, April 30th, we did have a nice down day. You could have nibbled on some stuff, whether it was Meta or Microsoft, which both of them reported earnings. We'll get more into that. But some of your favorite stocks that you deem are undervalued. And I favor very heavily software stocks here that are reliant on AI, like Microsoft, like Meta, like Google, that do not have tariff exposure. So looking at this data here and what I told you guys in my last couple of videos and what I told the traveling trader trading and investing group, when I'm looking for a hedge, this data here to me strengthens my, I don't want to say opinion, but strengthens my thesis that this is a good time to hedge. So here's what I'm looking at in order to hedge short. I'm looking for NQ, as I told you guys in the last video, to take out the Liberation Day high, the April 2nd high, because this right here is when all of the uncertainty was really exacerbated. And I suspect that ES, or the S&P 500, will not take that April 2nd high. You could see that it's lagging behind. This would create what we call bearish divergence, because if the S&P 500 makes a lower high, right, at some point, just a lower high, basically not going above that, and the NASDAQ makes a higher high and takes liquidity above the Liberation Day high, that is called bearish divergence. Remember, I told you guys that if we're looking at, let me just pull the SPX chart up. If we're looking here, we are likely going to see some resistance here. We have a huge cluster of consolidation here. The S&P 500 spent a month consolidating here. We have the 300-day moving average, and then obviously the Liberation Day gap, and then NQ has the Liberation Day high. So if we create that bearish divergence where NQ makes a higher high, but ES does not breach that high, then I will for sure be taking a hedge here. And I already told you guys how I was hedging, but I will likely buy debit put spreads on SPX and or SPY, depending on what your budget is. I may get into that towards the end of the video, details on that. Now, Meta reported earnings, absolutely smoked earnings. Is that a surprise? Not really. What we were looking for was AI spend and guidance. Surprisingly, Meta confidently announced guidance, which they didn't have to do. A lot of analysts were questioning what companies are going to give guidance and what companies are going to avoid it. But Meta, not only did they smoke earnings, which I think that was expected. Meta, Microsoft, Apple, they always beat earnings. But you can see here, earnings per share, 6.43 versus 5.28. Revenue, 42 billion versus 41. Now, what's insane is that they are increasing CapEx for AI. The reason that I didn't really think that CapEx for AI would stop at the mega caps, one, they have a ton of cash, but two, their business literally relies on it. So imagine Google doesn't increase their spend on CapEx, which they did as well a week ago. But imagine they don't. They're going to die, right? That their main competition is ChatGPT and some of these chatbots, these large language models. So they have to spend on AI, especially while they have the money. It is literally their survival that's at stake. Same thing with Meta. They are increasing their ad revenue and even better directed ads because of AI. And if they don't increase their spend on AI, then they stop the growth of their ad revenue, which at one point was pretty stagnant. So these companies have to spend on AI. And it's great that these software companies that don't have a tariff risk are actually giving guidance. So they gave guidance and their guidance was in line with expectations. Microsoft also beat their earnings, which again, this to me was not a question, but 3.46 versus 3.22 earnings per share, 70 billion versus 68 billion. They are also one of the only companies that is making money off AI now. So you can see here it says the company's Azure growth grew 33% with 16 points of the growth associated with AI. And they also announced that capital expenditures will grow in the new fiscal year, though at a slower rate than 2025, but still growing. They obviously have a much different business model than Meta or Google, and they also issued surprisingly strong guidance. So we are not seeing any weakness from the mega cap techs. Like I said, I thought mega cap techs, some of the stocks in the Mag 7 were heavily discounted, and you cannot afford not to pick them up at 35% down, trading at PE ratios that we haven't seen in 10 years. Even if the market goes down after this, which we'll discuss, just crazy not to pick that up, honestly. And seeing this, I would not shy away once again from the strategy of picking up these stocks, Microsoft, Meta, Google. And if you needed this to convince you, which I don't think you did, but after seeing this, I would still stick with the strategy of picking up these mega cap software stocks on red days. Like even today, before earnings, Meta was trading down 25% from highs. All right, so before I go back to the chart and the trades and tell you how I'm likely going to hedge short coming up here, I want to revisit the data just a little bit. So if unemployment comes in higher than expected, then I think on May 7th, do we have CPI next week? No. On May 7th, when the FOMC tells us whether they're going to raise or cut, if unemployment comes in significantly higher, not just 4.2 or 4.3%, but say it comes in at 4.5 or 4.6, I really think that there is a consideration on the table for either a rate cut, especially now since the White House has been hammering for a rate cut, or some sort of quantitative easing announcement on May 7th. The preferred gauge that the Fed likes to use, which is PCE and core PCE, came in 0% month over month, and we are starting to see cracks in the employment numbers. So the big employment number is going to be the unemployment rate, and if that comes in at 4.5 or above, I really think that there's a heavy consideration on May 7th, which we will obviously cover live, that the Fed has to at least consider quantitative easing and or cutting. So if we get that bearish divergence that I was highlighting between NQ and ES, then I will likely open up a pretty good sized hedge, 10 to 20% of my portfolio. I want to go 30 days out. So in this case, I might go May 30th, and I will likely buy if I go back to the chart real quick, let me hit up SPX so that we're trading apples to apples, but I will likely buy somewhere around the 5350 or 5300 puts here, or put spread. So if I go May 30th and let's say I buy the 5350 puts and I sell the 5300 put, this would cost me $1,000 per contract, as you can see here. If the S&P is 5,300 or less by May 30th, would net me around $4,000 per contract. So I like this type of hedge if I open it up with 10 to 20% of my portfolio risk. So if your portfolio is $100,000, 10% of that is $10,000. So your position would be $10,000 risk. Obviously, tune it to what your risk tolerance is, your portfolio size, etc. You can also do it cheaper with SPY if you don't have a large portfolio and would rather do it with something that has a cheaper price. If we go out to May 30th, let me just make sure we're doing apples to apples. So go to the SPY chart. Yeah, maybe 535, 530 puts on the SPY. So same thing. It's a put spread. That's what I would prefer doing here, so I don't get eaten up by theta and volatility crush. But buying the 535 puts and selling the 530, it's really the same proposition here. It's going to cost you $100 per contract, and the max that it's going to pay is $400 because it's a $5 wide spread. So that is how I would prefer to really hedge here. And again, when I spot the bearish divergence where NQ takes the Liberation Day high and ES doesn't, that is the day that I will likely open up the puts. Obviously, I will alert this in real time as I've been keeping the crew updated, saying why I'm not hedging right now and what I'm looking for in order to hedge. I'll send this out in real time. If you want all of our alerts in real time, sign up below. If you day trade, swing trade, long-term invest, you definitely want the full membership. If all you care about is investing, you don't care about swing trading or day trading, then you can get the one that is a little bit more affordable. I think it's like $35 a month, but you won't trade with me live on that tier every single day. So just make sure you look at the details when selecting the membership tier. And lastly, just to close out about my thoughts on the market upcoming, there is some analysis that says, this super fast 20-point drop, and it was really violent, the most violent drop since the pandemic. And the pandemic was the most violent drop in my lifetime, right? But this violence of a drop was obviously due to a lot of uncertainty. And then some analysts are claiming that this is pricing in a mild recession. Yes, I guess a mild recession, minus 20% on the S&P 500, minus 25-ish% on NASDAQ. Those are mild recession numbers, right? But if you look at how some research groups are analyzing what is the potential based on the tariffs, if the Trump tariffs don't ease up, then for sure we're going to see containers to US ports come to a stop. We're going to see empty containers. We're going to see empty shelves. I don't know that the Trump administration takes it that far. I really have no idea. But if that's the case, remember, bond yields are my barometer. If bond yields haven't come down to a satisfactory level, then yeah, I mean, they might keep their foot on the gas with the tariffs and throw us into a recession, bring down rates, be able to refinance the treasuries. If that's the case, I do think something like this is plausible where we get a summer recession. We already got one negative GDP number, right? All we need is another one to give us a summer recession. Although during Biden's term, we did have two back-to-back negative GDPs and they didn't call that a recession, which was funny. But if this is the case and we get a negative Q2 GDP number, just like we did in Q1, then yeah, I think we can get a summer recession. I don't think that this is the extent of the drop and we just go back to all-time highs. But, like I said, a double dip correction, similar to what we saw in 2015, is possible. But with Meta and Microsoft and Google reporting these earnings, obviously we still have Amazon and Apple. Amazon and Apple are way more affected by tariffs than these other companies. There has to be real uncertainty reintroduced into the market in order for us to see another drop of this magnitude. And that uncertainty would be that the tariffs are actually taking place and we are actually seeing shipping lines being affected. We're seeing empty containers, empty shelves. That is the type of uncertainty that I think can match or even beat this move down that we recently saw after April 2nd. If it's just some more of this hemming and hawing, yeah, 100% tariff, no 20% tariff, no 10% tariff, I think the market is exhausted from that. And I know what market exhaustion looks like. I think there has to be something material for us to see another major drop. Now, I'm not talking about just a retracement down to fill this gap, which I think will happen. I mean like a major drop, something that will actually cause a recession. And I think that a slowing down economy with shipping containers stopped, with empty shelves, with high prices causing stagflationary fears, that type of thing. But this like back and forth with the tariffs, we made a deal. No, we didn't. We made a deal. I don't think that just that alone is enough to bring us down. I hope that makes sense. That is just my speculation, honestly, from being in the markets and seeing moves like this, but also looking at this move here where this was peak uncertainty. And in order to match that, we would need something that would raise the level of volatility and uncertainty more than what we heard. And we've gotten hundreds of applications already for the private group coaching. I'm only taking 10 traders. This is only if you're interested in day trading and swing trading. This is not for investing. So do not sign up if all you're interested in is investing. I might do something similar for investing at some point down the line, but this is only for day trading and swing trading. Private group coaching taught by me. I take 10 traders and I go over your trade. I review your trades, your psychology, your pitfalls, what has been holding you back, what are your strengths. We try to boost your strengths. We try to limit your bad habits and basically in 8 weeks turn you into a much better trader than when you first started the program. So if you want to apply and be potentially one of the 10, make sure that you click the link in the description. Keep your head screwed on straight. If you're going to buy on red days. That is just my suggestion, not financial advice. Do what you like at the end of the day. But leave a comment down below. Let me know what you think is going to happen to the market and the economy by the summertime. Do you think we're going to see empty shipping containers and empty shelves? Do you think we will see a double dip correction? What are you planning on doing with your hedges? What stocks have you bought or wish to buy? I love reading all the comments, so leave it down below. I'll read and respond to it if it's in good faith and I see it. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.